you're having pay withheld and it's going to the government by way of the taxes, your HECS debt gets indexed up in June before you lodge your tax return. So it gets indexed up in June, but then your payments that you've had withheld throughout the whole year don't actually end up on your HECS until after you lodge your tax return, which is after June. That whole system just absolutely drives me insane. And I don't know, maybe in a future life, I can help try and change these things or whatever it may be, because that is one thing that just doesn't make sense, how that whole system works. You're having it withheld from your pay, doesn't even end up on your HECS debt, and then it gets indexed up first, and then it goes onto your HECS debt. So. All right, welcome back to the Winners Playbook. Tax time rolls around fast, the refund hits your bank account, and for a lot of people, it's gone just as quickly. Today, we're going to be breaking down why so many people waste their tax refund and what smarter moves you can make instead to actually get ahead. But before we dive headfirst into that one, Billy, I'm going to throw it over to you, mate. What's the latest and any cool things upcoming in your life? Sorry, mate.
Yeah, mate. Yes, a lot going on. Heading off to the US in a couple of weeks with a group called Inside Network. So it's a big group of financial advisors. They call it a study tour. So we're going to go, and you did it last year, right? So we're going to head over to New York, Boston, and LA, meet with some fund managers. We're going to check out Harvard, go to a baseball game in Boston. Yeah, so that's awesome. And then I come back a couple of weeks later, we're going to move house. So this is it's chockers the next month or two. How about you?
Yeah, big end of the year. I can talk. Yeah, the US study tour last year was awesome. I hadn't been to the US before. It's a big journey getting over there, that's for sure. The flight over to LA and then LA to Boston, it's a massive trip, that one, but totally worth it and good experience. Going to the baseball was actually quite fun. I used to love and watch a lot of baseball when I was younger and played a lot of T-ball actually when I was like early, I think when I was like 6 or 7, used to love that. And getting over there and watching that was that, what's the stadium called?
Fenway Park.
Yeah, that's the one.
Yeah.
Yeah. And we'll sort of ride up in the back, and every home run that gets hit, there's like this nice little techno music that's playing every time there's a home run, and the crowd goes berserk. So yeah, you'll have a lot of fun over in the US. And yeah, I'm doing a bit of travel upcoming as well, heading over to Singapore, see the team in the Philippines. After that, got my birthday in the next month or so, which is exciting. And yeah, there's lots going on in the business. We're still decking out the newer office fit out, which we're closer to finalizing. A lot of hiring in the business as well. Got some new advisors that are going to be hopefully joining the team in the near future as well, because the team is expanding rapidly. So you put all of that together and doesn't leave much time for my own things, Billy. So it's all busy as usual.
Very good. Very good.
Cool.
So what are we talking about today?
Well, tax refunds, and a lot of people have I think a little bit of a misunderstanding as to how the whole tax refund and tax system works in Australia in general, and I personally see a lot of people feel a bit like it's free money, and then they get onto this tax refund and it's like, well, this is free money from the government. Let's go. If we just stop and start there for a moment, Billy, do you want to talk a little bit about why do so many people misunderstand like that, how the tax system works and tax refunds? Because ultimately, if your employer has deducted the right amount of tax from your pay and you don't have any deductions, you shouldn't have to pay any tax when you lodge your tax return, nor should you be getting any extra money back in your tax return, depending upon what you are earning, because there are some low and middle income tax offsets that have existed from year to year. But in general, Billy, why do people get it wrong?
Oh, our tax system is very complex, and often governments will try and throw us these little treats to try and win our votes. So remember we had like what was it called? The tax rebate, the low
Yeah, we had limiter.
Yeah, so they were sort of just giving everyone refunds for a couple of years there. And then people thought that was just normal. They were going to get that refund every year. Then it got switched off. And then, a lot of people got upset about that. So the tax system is complicated. And the main thing I think is like when you get a refund, it's in your bank account as a payment from the Australian Tax Office. And so people think the government and the tax office has kindly gifted them some money for them to spend. But the reality is it just means you've overpaid tax throughout the year. And, oh, yeah, you overpaid. Here's your refund. So you worked hard for that money. So you should not see it as a gift from the government. You should see it as, well, this is part of what I earned for the year, and then act accordingly. That's what I think. An example comes to mind. I had a client who they had a HECS debt, and you tell your employer you've got a HECS debt. They withhold more money from your pay each week to pay it off. They didn't tell their employer that the HECS debt was paid off. So they were getting massive refunds every year because the employer was withholding way too much tax. And were getting like a $20,000 refund each year. And they said to me, we really like it because it's like a bonus each year. And I'm like, I understand what you're saying, but that's your money. And the tax office gets to keep it all year and earn interest or whatever they do with it. And then they give it back to you. So it's like, well, just get it, get it when you're entitled to it. Don't wait for this refund each year. Yeah, I mean, that's what I see.
Yeah, it's interesting because there's a lot of different reasons where there was, I think it was not last year, the year before that, when 𝗺𝗲𝗳𝗂𝗵 got taken out, and that, I think from memory, that was up to $1,500
Yeah.
when you were earning up to roughly, I think 120 or 130,000 thereabouts, where you would get the full benefit of the $1,500 or so back in your tax return, and that was really, was like free money. And then when that was then taken away, everyone was like, "Hang on, like what's happening?" But there are a lot of other reasons, and one of them you just touched on, as to where people get a little confused around why they get tax refunds or why they sometimes owe money to the tax office when they go to lodge their tax return. Because you mentioned the HECS one as an example. Yeah, if you don't have that HECS anymore, you don't need the HECS repayments being withheld from your pay. So it's kind of like a forced saving. But I'm with you, Billy. I don't want that money sitting with the government. Like, get that in my pocket now. Like, if you've got a loan, put it in your offset account, so it's at least working for you. But then other reasons why you could end up being an owing situation, is where you say you have a HECS debt and you don't actually let your employer know to withhold any money from your pay. And then you go and lodge your tax return, and then the government says, well, because you've earned, I think it's over roughly $57,000, and then there's those mandated HECS contributions. Well, you got to hand that over. And then you're like, well, how does that work? But no, it's just how the system is there. It's just that you haven't been aware of it. Another one I see commonly people get wrong is like with a second job. And
Mhm.
normally on your main job, you claim the tax-free threshold. So it's a little box that you tick when you join with your employer and you fill out that tax file number paperwork. And there's a box you tick to claim the tax-free threshold. Whereas if you tick that also on a second job, you're going to be having not enough tax withheld. And then when you go to lodge your tax return, lo and behold, you're going to owe some more money by way of tax. And then that's where there's a misconception where people think they're actually getting taxed at a greater rate on a second job. It's not actually how the tax system works. Like, all of your income basically gets pulled together in Australia, and then that will determine how much tax you pay based upon the tax bracket that you fall within, and incrementally how you've worked your way through all of those. But sometimes people feel like they get a second job and they're going to be taxed more. That is because you generally won't be claiming the tax-free threshold. So your employer will withhold more tax from your pay every pay cycle. So there's that as well that I see commonly people get a little bit confused around. And then there's the whole deduction system that I think a lot of people really misunderstand in terms of buying and getting deductions and trying to maximize your deductions, which you should do. To be clear, you should be trying to maximize your deductions. But I think people fall into a trap when they start going out and buying things just because they're tax deductible, just so they can save some tax. Because how the tax deductions work is, you spend $1,000, you don't get $1,000 back in tax. You spend $1,000, you'll get back equivalent to the tax bracket you were in. So if you're in the highest tax bracket and you're up at 47%, you spend $1,000, you'd get back 470 of it, but you've still spent the other $530. So that is probably one of the biggest misconceptions I see a lot of people misunderstand. And I've seen friends and family going out and buying things just before the end of the financial year because they're going to go out and spend that money to hope to save tax, which in my opinion is not a great way of doing it unless the items that you are buying genuinely do help you in earning your income, or will help you earn more income, or help you upskill or educate yourself, or whatever it may be. If those deductions are applicable and they're going to help you earn more income and help you get further ahead, well, then it's worthy. Or if you're going out, and I've got a friend that does this, he goes out and buys a laptop or a phone every year. He doesn't need those things, but he's doing it because he's trying to just save a little bit more extra tax. Do you see that from time to time, Billy?
Yeah, people get so upset about paying tax that they'll self-sabotage in order to pay less tax, and that's a classic example. Just spending money just to get a bit of a cut on your taxes, but it actually hurts you.
Yeah.
The tax office don't care about you, so you shouldn't care about them. Just do what works for you.
Totally agree. And we were talking on tax. We're not going to dive into properties in this podcast today, but like negative gearing, goes alongside that as well. And that's where I hate when I hear people say that they want to buy a property just to save tax. Like, God, it drives me insane. Like, do you have that come up often, Billy, with clients and property?
Well, what I've seen a few times is there'll be a couple, one's a high income earner, the other's low income. They'll buy a property for the high income earner so you can get negative gearing benefits and save on tax. Then a few years later, they go to sell the property and they get whacked with a massive capital gains tax bill because it's in the higher income person's name.
Yep.
So yeah, you shouldn't you shouldn't make your decisions solely on paying less tax short term because it can come back to get you later.
Yeah, I totally
Yeah.
agree. And talking with the property one as an example as well, like this is something that a lot of people won't know is, when you're buying investment properties, that typically they will be negatively geared unless you're putting in maybe a 30 or 40% deposit these days, just because of where interest rates are. But hey, interest rates are falling, so that's positive news. But one thing a lot of property investors I don't think realize is if you're an employee and you've got an investment property that's negatively geared, say it's running at a loss of 10 or 15 or 20 grand, or maybe more if you've got a lot of property, you can get your tax return in advance of before you actually do your tax return at the end of the financial year. So what I mean by that is, rather than waiting to the end of the financial year to get the 15 or the 20K or whatever it would be back because you've got a heavily negatively geared property, there's something called a PAYG variation where you can apply to the ATO, basically declare all of your income, the expenses, everything associated with the property. And then rather than waiting, to the end of the financial year to get back that 15 grand, you would actually incrementally get it back over the whole of the financial year because the ATO then notifies your employer and withholds less tax from your pay cycle. So it goes back to the part that you said earlier, Billy, around that client with the HECS debt
Yeah.
of, would you rather the ATO just hold on to that money for you, or do you just get it sped up and paid in advance because, you could be better deploying that. You could be investing more money. You could be saving. You could be paying down your debt, putting it in an offset. That's one I see not a lot of people actually know about. So I think that's one always to remember. And yeah, any other comments on the property side of things, Billy, before we move off from that?
No, I don't think so. I think you've covered it. Yeah, the variation is, yeah, if you're getting a big refund or a big tax bill every year, it generally means you need to make some changes, especially with the big refund. The tax office gets to sit on your money all year
Yeah.
until you do your tax return. And the other thing on that, if you owe tax, the tax office will charge you interest, right? Like if you don't pay your
Yes.
tax on time, if they owe you money, they're not going to pay you an extra bonus. So it's like they're happy for you to get refunds because it means they get to sit on your money for longer. So you don't want big refunds.
Yeah, look, I don't want to smash the tax office on today's podcast, but you know what? Other thing that just shits me is the HECS system. Like the way that the whole HECS system works, where you get the money taken away from your pay throughout the whole year, but then the government, it doesn't get put onto your actual HECS debt until you lodge your tax return. So the whole year, you're having pay withheld, and it's going to the government by way of the taxes. Your HECS debt gets indexed up in June before you lodge your tax return. So it gets indexed up in June, but then your payments that you've had withheld throughout the whole year don't actually end up on your HECS until after you lodge your tax return, which is after June. So that whole system just absolutely drives me insane. And I don't know, maybe in a future life I can help try and change these things, or whatever it may be, because that is one thing that just doesn't make sense how that whole system works. You're having it withheld from your pay, doesn't even end up on your HECS debt, and then it gets indexed up first, and then it goes onto your HECS debt. It's like,
No,
I don't know, it's bonkers.
it's not about fairness. Got into an argument with someone online because because I called it interest on your HEX debt, and they said it's not
Okay.
interest, it's indexation. I said, please explain the difference because either way, either way, you got to pay more every year.
Yeah, well, exactly. Like
Yeah.
it's
In
just
fact, it's
charged
worse than
once.
interest because, as you said, the repayments don't go off the debt until after they've added the indexation.
Yeah. No, I totally agree, but we'll get off the ATO for the time being. We'll move on. But what about if we're talking about, what are the worst ways to spend a tax refund? I suppose it's a little bit subjective, and it depends upon what you're actually doing in your life, because you might be doing a lot of the right things, and then your tax refund could actually be a nice bonus that you use for holidays. But what are the things that people are generally doing wrong with their tax refund?
I think it's purely just acknowledging that you earned this money and it's your money. Like, it's not a bonus, it's not a gift. Like, you actually worked for this money, so you shouldn't treat it any differently to money that you got in your pay or a bonus or something like that. It's just more money that you earned that's coming through in a lump sum. And so I think a lot of people, they just get excited because a lump sum of money lands in their bank account. They're like, sweet, I can do something fun, which is fine. But I think it's just realizing you earned this money and treat it like you would any money you receive from your hard work. And that might be splurging at times, but it might also be saving or investing or doing something productive with it as well.
Yeah, I totally agree. And if, like, what are the other options if you're not doing those things? Well, it's pretty simple. Like, I don't think it's actually overcomplicated what your options are. It's either one, you might use that money to start chipping down on some debt that you have. You could, of course, start investing that, and I'll give an example here of what that might look like. Or you could, save, or maybe use that as a reinvestment in yourself. So, like, every year you get that tax refund. If you're so concerned about paying taxes, which you really shouldn't be. You should be concerned about trying to figure out how to earn more money, because paying tax is just going to be a part of it. But don't get me wrong, you don't want to pay more than your fair share. So you still want to make sure you are doing the right things and optimizing your situation. But God, if you took your tax refund and reinvested back in yourself into some course or upskill yourself or whatever it may be, I don't know, the world might be a different place.
Well, if you do that, you can thank the tax office.
Yeah, you can.
You go and reinvest that into yourself and earn more money.
Yeah.
Like, thanks ATO for that refund. It changed my life.
And mind you, that refund could then also be tax deductible, because you spend it on things that are tax deductible. So it's just this never ending cycle. So
Sounds like a loophole.
we're onto something. Maybe we're actually onto something. But what I was thinking of, the investment scenario. So look, the average tax refund, I was just Googling before, doing that before we hopped on. The average tax refund last financial year across Australia was about $2,500. Okay. It's about $2,500 was the average tax refund. So if you took $2,500, you invested that typical sort of high growth portfolio, let's just add in some inflation there. Maybe you're getting about an 8% real rate of return over a longer period of time, let's just say. In 30 years' time, that would accumulate to roughly $280,000. And that would have had you have only invested $75,000. So you've put in $75,000, but that has snowballed on itself into 280 grand over a 30-year period of time. Now, I know that's probably not sexy, where you take that money and you invest it over 30 years, but look, these are the little things of which where you can do, and maybe that's taking your refund and you're doing that because you want to help your kids in future or whatever it may be. But there are a lot of other options as opposed to just, it's free money and, let's go on that holiday, which is, I reckon, where most people would go with it is, probably holidays is where that tax refund goes. What do you think?
So I think we've been working together too long, because I did a calculator as well.
Oh, did you? What did you calculate?
I was a bit more bullish. I've put in a 10% return.
Oh yeah, I like that. Where'd you end up with 10%? How much?
Well, so because we wanted a decent number, so I've got 10% return for a couple, so I did $5,000 a year.
Good.
So in 10 years you're 90K, but in 20 years you're 300K.
Yeah. So now we're cooking.
Yeah, and then obviously, especially if you've come to see us, you're obviously investing every month as well throughout the year.
Yeah.
So the refund just gives you a big boost.
Well, if you play that scenario out, let's stick with that for a second. So we had what do we have? We had the $5,000 a year.
Yeah.
We say on the tax refund, and let's just say that if you're getting a $5,000 refund, you're likely going to have at least $1,000 a month that you could invest. You're probably earning decent enough income where we could scrape out some things and we could get another $1,000 a month to invest. So let's just say you've got your $5,000 refund and then you're investing $1,000 a month. So that's what, $17,000 a year we're going to invest. And we're going to go on your 10% return, which I'm happy with. And let's go annually. So over 10 years time, what's that put us at? About $250,000 in 10 years time. So we're up at about $250,000. Sorry, that's an 8% return. If we go a 10% return, so I've got these rookie numbers in my calc. What does that put us at? About 270 over 20 years. This is where the compound interest will start taking effect. Over 20 years, that's nearly $1 million at that point in time, if that's all you do. And then over a 30-year period of time, this will really blow some minds. That would balloon out to nearly $2.8 million.
No, it's just 1,000 a month and a tax refund.
1,000 a month in a tax refund. It's pretty mind blowing
Yeah.
when you look at it that way. That's really is the power of compound interest, and that's where when I speak to some clients, sometimes it's really the game of life and just having flexibility and freedom. It's not overly complicated. It's just it takes time. That delayed gratification is what I think everyone really struggles with, and I'm not immune to it as well. That's what I think. Just if you can get a grasp of that and just chip away, and you don't have to go overly complicated with these things. Just take your tax refund, $1,000 a month, invest in the right things, and gradually accumulate on that over time. You can really set yourself up. So,
Yes, and as you say, it's boring, but so one of the wealthiest people on the planet is Warren Buffett, and he famously still lives in the same house he bought decades ago when he didn't have much money, still drives the same car, still has McDonald's for breakfast. And the returns of his fund or his investing, they're not mind-blowing. Like, if you look at the last 30 years, they're not mind-blowing, but he just gamed compound interest better than anyone on the planet. He just reinvested for 60 years. So it's just, you don't have to be Warren Buffett, but the point is, it's just consistency and a habit.
yeah. And if anyone listening goes on to the Money Smart compound interest calculator, you can punch in the exact figures that we just did. And if you look at the graph, which obviously we'll talk it through on here, is there's a dark blue shaded line, which is kind of like all of your contributions. So over that 30-year period of time, you would have contributed $510,000 in that example that we just read out. So the other 2.2 to 2.3 million is all just interest. But if you look at the actual interest, it only starts really getting larger than what you've put in around sort of the 10 to 11-year mark. It's a long time. So, everyone's too busy looking at the early days of like, what are my returns, too short term? And I've heard you say this a lot, Billy, to clients, is like the most important thing in the early days is just getting the dollars in the account. Like, you just got to get invested and start actually building a base.
Yeah, exactly. The returns don't matter in the first year if you're starting from zero. It just matters that you're doing it. And then the returns matter a lot after you've been doing it for a few years.
Totally, totally, totally agree. And what about if we talk about a bit of a mindset shift that can help people see their refund differently? I was going to mention here is don't see it as free money, which I think you've already said as well. But is there anything else that you would you would tell your younger self, even Billy, of just how you would approach tax refunds? And
Yeah, well, firstly, as we've spoken about this, if you get a big refund, then you got to question, hang on, am I not managing this properly? Because why did I get such a big refund?
Mm.
That's the first thing. Second thing, as we've spoken about, it's not a gift from the kind old tax office. Like, it's your money you worked hard for all year. So just think about it that way. And then the other note I've got here, it's one of the questions we've got noted down. What's a simple plan someone could follow for the next refund?
Yeah.
I think it ties into this. So we don't want to be like dour and boring and say you got to invest it all and wait 30 years. So I do this with all my clients. Any windfall amounts, so bonuses from work, tax refunds, you just split them in a percentage, right? So you go 20 or 30%, I'm going to just blow on whatever I want and feel no guilt about it whatsoever. And then the rest I'm going to save or invest or use for tax reduction or whatever it is. So you have fun now, and then you also look after your future self. So just a very simple rule. Every refund has to be divvied up.
Yeah.
So you don't blow it all, but you get to blow a chunk of it.
Yeah, and I think the most important element there is like just actually having a plan and not just being, reacting to the situation or making a call off the cuff. Because that's, I think, when people, get themselves into problems. Because that was where I was going to really finish on is with this, is we're not saying that, you shouldn't go out and spend your tax refund, but just, kind of know where it fits into the broader plan. Like, if you're investing heavily and making all the right moves over the year, maybe the tax refund is something that we view as a bonus, and you, like you say, Billy, you go out and blow that or whatever it may be. And I've got scenarios for clients who have these very much negatively geared properties where this money comes in, and I've said just use that every year for a holiday, because that's fine, because we're accounting for everything else in the plan and the system that we're operating. And even sometimes, maybe a point to finish on is sometimes advisors can help you manufacture a much greater refund than you would usually get by using like super contributions. I've got a lot of clients that make a lot of super contributions year on year. A lot of retirees or not retirees, getting close to retirement, but they're over age 60, where they're, maybe taking some money out of super, loading their superannuation up and claiming big tax deductions for it. I've had a lot of clients do that in the last couple of years, and we're actually manufacturing these really large, tax refunds. I reckon the biggest one I've probably seen was about 60 grand that we did. And that was with
Sweet.
some, yeah, that was sweet. That was with some catch-up contributions. So the clients hadn't contributed much money to super for a 5-year period of time. It was a couple that hadn't been in Australia for quite some time as well. And they were selling a property and had a big tax bill and things like that. So we dumped a lot of money in super and claimed it back as a tax deduction. But yeah, something that a good advisor is always going to look at with you. But my final note there was just be purposeful with it. Don't just think on the fly. And if you've got all of your investing, saving, and debt repayments sorted throughout the year, that the tax refund may be able to work as a bit of a holiday and a splurge fund or account. So yeah, before we close out, Billy, any other points or anything that we've missed out there?
The only thing I've missed is if you have an accountant, then you'll have more certainty around this, that you're doing it correctly. And also, you want to know if there's going to be a refund, because I've seen clients who they get a refund every year and they rely on it. They're like, when my refund
Yeah.
comes,
Yes.
I'll do this or, fix this in the house, whatever it is. If there's a year where the refund doesn't come, they're like panicking. So, whereas if you've got an accountant, everything's set up properly, you'll know if that's coming or not, how much it's going to be, and you'll be able to then plan it out rather than just submitting your tax return and crossing your fingers.
It's a good point to finish on, Billy. And funnily enough, my accountants just emailed me before with their cost proposal for the next year, and my eyes are watering just a little bit. So, but that fee is tax deductible. I guess that's a
That's
positive
something.
that it is tax deductible. But we might finish up there. And I guess the key theme today, guys, is your tax refund isn't a bonus. It is your money that is coming back to you. So treat it like an opportunity, not a shopping spree. And if this episode got you thinking differently about your next refund, hit follow, leave us a review, and send it to someone who's already planning for their next splurge. Until next time, Billy, we'll see you on the Winner's Playbook.
Thank you, Josh.